For years, UK equities were unloved by the market, neglected, left alone. Words were said, sales were made. They were ditched for having Brexit. There were no shiny tech companies that could offer phenomenal growth like the US. Just over 2020, UK investors have taken out £10 billion of UK equity funds and preferred to transfer them across the pond to the US. And at the same time, the UK GDP dropped 9.9%. It was the worst drop against all its peers and its own history as well. It was the steepest annual decline in 300 years. Yes, we had the World War I, World War II, and the global financial crisis in between all of that. The worst calculated drop ever was in fact in 1709 when harvest failed after the Great Frost. People have called the UK stock market boring, full of dead wood, and maybe even pointless because it is stuffed with old school banks, tobacco companies, and oil majors. And they were going sideways even before COVID arrived. There was no love, no light at the end of the tunnel. But no more. Since the beginning of 2021, things have finally started to look better, making it a great time to start investing in the UK. Hi guys, I hope you're all doing well. So today I'm super excited to put my case forward for investing in the UK stock market. And believe me when I say I have been waiting for this day for quite a while now. So here are 5 major reasons why I think it's time to give some love to UK equities. Well, of course, we cannot start this without mentioning Brexit. Regardless of how you voted for Brexit, well, there is a 50-50 chance that you voted for or against it. Well, it doesn't really matter now because we finally have a deal. UK equities were losing momentum ever since June 2016 because of this uncertainty. And if there is one thing that you should always know about the stock market, and it applies across all the stock market, is that it hates uncertainty. What I'm trying to say is that the UK stock market was not being penalized because it had Brexit. The reason why it was being penalized is because no one really knew what the hell was going on. But now that we finally have a deal, that uncertainty is no longer there. And so investors across the world, including the UK, now have a much better direction of travel for the UK stock market. I mean, that's all we have been asking for. Sticking to Brexit, we have to mention the pound. When Brexit vote happened, the whole stock market, including the pound, declined and sold off. However, within days, FTSE 100 index in particular started to recover rather quickly. And this is because the market suddenly realized that the weaker pound is actually pretty good for the UK large cap companies. And this is because most of these UK large cap companies generate their revenue from outside of the UK. And so a weaker pound is actually working in their favor, because with weaker pounds, these companies are able to convert their non-sterling revenues from overseas into sterling income and get a major FX boost. And higher FX boost translates to higher revenue, which ultimately translates to a higher profit. I am talking about large cap companies such as HSBC, BATS, and Unilever. However, by the same logic, companies that makes most of their earnings in the UK were hammered the most, while their revenues were in pounds, but their costs were in a different currency. And so when those costs were getting converted into pounds, it was negatively impacting their profit margin. And now, because of the Brexit deal, we finally have pound strengthening again. This is a great news for some of our home bias companies, which make up most of FTSE 250 index. Here's a chart to help you see the difference. FTSE All Share Index only has 26% of revenue coming from the UK versus 41% in FTSE 250 index. Quick important side note, about 80% of FTSE All Share Index is actually made up of FTSE 100 index, while at the same time FTSE 250 index does not include any of this FTSE 100 index. It only holds the next largest 250 companies. So what does it tell us? It basically tells us that to get the maximum potential benefit, we need to diversify our exposure within the UK index level itself. So I personally prefer to have about 1/3 of my money allocated to FTSE 100, FTSE 250, and FTSE small cap ETF or an index fund, rather than holding FTSE All Share Index as a whole. And since I want more exposure to growth element of investing rather than dividend, I prefer to have more tilt towards FTSE 250 and FTSE small cap Index. Number 2 is all about dividends. In comparison to some of the largest countries across the world, UK actually has the highest dividend yield. Last year was terrible for UK dividends. There is no doubt about that. Analysis from Morningstar shows that the average fund paid out 36% less in dividends in 2020 than in 2019. But the good news is that by cutting dividends last year, some of these companies are now in a much better positions, talking financially, which means they can now start to reinstate those dividends much quicker. Personally, I don't invest in high dividend paying stocks, but for those who do want to invest in high dividend companies or part of the market, then the UK stock market remains as one of the attractive points. And the third point is about the UK economy. Yes, I understand that the headline figure looks pretty terrible, but it is not as bad as you may think. Let me explain why. The UK actually measures their economic activity in a different way compared to the rest of the world. Output of economic activity is basically measured by GDP, or gross domestic product. Economic activities is not very easy to measure, especially those that falls under services. I mean, you can all easily tell how much a basket of bread and eggs is going to cost, but how do you actually measure output of services sector, such as the army, the NHS, or the schools? Well, historically, countries got around this problem by looking at numbers such as levels of spending and the number of staff employed. However, in recent years, the UK statisticians developed a much more accurate and better measure using actual level of output. For example, we would look at number of visits made to the NHS compared to how much money was spent. What this meant for the UK is that our GDP figure looked much worse compared to others, because due to COVID, the NHS postponed a lot of procedures and schools were shut, which impacted our calculated numbers. So the great news is that when you compare UK GDP figures across its peers using the old accounting method, it actually doesn't look so bad. In fact, we look very much in line and sometimes even better compared to other countries. But the important thing that I wanted to highlight is that a large part of the UK economy is made up of this services sector and social consumptions like restaurants. And so when the lockdown is over, we can really expect a big bounce back on this part. Bank of England chief economist said that the UK consumers had amassed some 250 billion during the pandemic, and the economy could bounce back like a coiled spring when restrictions are eased. Number 4, let's talk about valuations. Because the UK market was unloved for so many years, it is finally offering some amazing opportunity for us to, play part in its recovery while it catches up. To visualize what I'm talking about, let's look at Shiller's PE ratio, also known as the CAPE ratio, cyclically adjusted price to earnings ratio. This ratio is pretty similar to the normal PE ratio that most of us are aware of, except this ratio is as closer to the crystal ball that we can get. Dr. Robert Shiller, who I had the pleasure to meet and is a great gentleman, introduced this ratio in 1988. He is one of the finest American economists and a Nobel Prize laureate. While the normal PE ratio is calculated using 1 year of earnings, Dr. Shiller suggested that 1 year of earnings figure is too volatile to estimate the real market value of a company. Instead, he proposed using the average of the company's earnings over the last 10 years, adjusting for inflation. 10 years because a business cycle of boom and bust typically runs for about 10 years. But is this ratio any good? Well, in the past, the CAPE ratio actually helped to predict some of the booms and busts of the economy. The historical average of the ratio for S&P 500 index is about 16. The record high level occurred 3 times in the history of the US financial market. The first was in 1929, right before the Wall Street crash, signaling the start of Great Depression. The second was in late 1990s, just before the dot-com crash. And the third came in 2007, just before the global financial crisis. So what is this ratio telling us? If the current CAPE ratio is way below its historical average, then that market is expected to do well over the next 10 years. And if it's way above, then it is not expected to do well over the next 10 years. Now that you know I am not making stuff up, let's look at some of this CAPE ratio for different countries and see how UK compares. At the moment, UK's CAPE ratio looks under 12 times, and historically the number was about 18. This makes it look really cheap at the moment, compared to the US, for example, where the current CAPE is about 29.8 versus its historical average of 16. This does not automatically mean that the US stock market will plummet once again. All it highlights is that risks are looming, and as a smart investor, it might be worthwhile to allocate some profit to other parts of the stock market like the UK, which looks so undervalued right now. And my final point is all about the composition of the UK stock market. Yes, the UK stock market does hold a lot of big banks, oil companies, and tobacco companies, and they are fairly boring with limited growth potential. And there are hardly any exciting shiny tech to even get us looking this way. But I want you to hold that thought because the landscape is changing, although very slowly. I know we all had big hopes for the Deliveroo IPO. It was supposed to be the largest tech IPO in the UK stock market. But it ended up being a bit of a disaster. Well, a lot of a disaster. But don't lose hope. Don't let this discount the future of having some great new tech companies joining the UK stock market. Because what's important is that the environment around listing of stocks in the UK is changing. For example, UK Chancellor Rishi Sunak is looking to overhaul stock market rules to make it easier for high growth companies to list in London. The reason why a lot of tech companies, even those founded in the UK, have gone to list themselves in the US market is because the US have more friendly valuation methods and rules around listing. But with the proposed changes along with the motivation for UK to embrace tech, going forward the composition is likely to look much more exciting. So here are my 5 major reasons for investing in the UK stock market. I would love to know your thoughts or even challenges. Do you plan to invest in the UK stock market? Why? Why not? Do let me know in the comment section below. And until next time, look after yourself and your money.